So without further ado, let me introduce my lovely panel who will be talking to me all about M&A for the next hour. I have Rebecca Hunt, who's a partner at the London VC Octopus Ventures. I have Mike Turner, partner at the law firm Latham Watkins. I have Alistair Crane, who's the founder of coaching startup Bloom and previously founded Hero, which is a live shopping platform acquired by Klarna. We all know about them in 2021. And Niccolo Maisto, who's the founder of gaming platform FACEIT, which he sold to Savvy Games in 2022. So we've got two exited founders who can tell us all about how you make it happen, and some investors and lawyers. So a great overview. So to get started, the big picture. Do we think, am I right in my intro ramble, are we going to see M&A pick up this year, and why is that? Who wants to go?
I'm happy to go first. Look, I think the one liner for me is it probably won't be as good as people expect, but it also probably won't be as bad as people expect. I think it will probably start to feel a bit more like the pre-COVID era. So steady state activity, steady number of listings. Most will be pretty good performance post listing, some other kind of private M&A, some more take privates. But kind of that, yeah, going back to the normal, I think, rather than any huge spike in activity, which I guess will feel like a spike from the last 2 or 3 years where it's been very quiet. But I think it's more coming back towards the normal would be my estimation.
I'd agree with that, Rebecca. The only observation I would make, which is different, is that I think that once the IPO window does open, there will be an unseemly rush for the markets. I think if Reddit could prove to be the opening of that window, we will see. But I think there are just a huge number of IPOs waiting to happen. Not necessarily all particularly positive IPOs, candidly. I think it's just, the only way that some companies can now raise capital is in the public markets, potentially. Not the private market. So I think that will be a little bit of a roller coaster for the next 12 to 18 months. But I'd agree with what you said. I think on the M&A front, we're beginning to see the activity starting to take place, Amy. And I think it's probably going to be an H2 process, not a Q2 process. But I think we're beginning to see those preparations being made.
And if we look at the kinds of companies, oh, my light's gone off in my little booth. If we look at the kind of companies that are both looking to and kind of setting things in place to acquire other companies, and the companies that are perhaps thinking about selling, what kinds of categories, sectors, stages do they fall into? Mike?
Yeah, I think it's there's been a nervousness about the value of the consumer market from a funding and an M&A perspective. And I think perhaps the greatest reset has happened in consumer. I think on the enterprise side, it's been a little bit more steady state. There's a different category of buyers. Rebecca hinted at that, with the sponsors, the private equity funds, particularly interested in the SaaS recurring revenue model businesses. So I think that will be strong. I think what you will also see, and you are beginning to see, and I think you reported on one just this morning or yesterday, you're beginning to see startups buying more startups. You're beginning to see some, let's say, challenged startups who are struggling to expand or raise the next round, now going into merger negotiations with perhaps a bigger counterparty in the market. So you saw that in the mobility world yesterday, and so I think you will certainly see more of that.
Okay, so if we get into some practicalities and bring in our founders, if I'm a startup and I, for whatever reason, think I'm not going to be able to raise as much capital as I need, or you know what, I'm just completely fed up and I don't want to do this for another 5 years, where do you even start, Alistair?
It's a really interesting one. I'm going to give an example that will draw similarities, so it's not exactly the same as what you're asking, Amy, where we remember what happened not that long ago in recent past with Silicon Valley Bank, which was a catastrophe, especially, by the way, I'll hold my hand up and say for founders like me that had the vast majority of deposits with the bank, where they became totally inaccessible. Now, the silver lining in the cloud was that we were quick to communicate with our existing investors, and delighted to say that the vast majority of our cap table was super supportive, of our unfortunate position that was really through no one person's making, but also reiterating their support for the upside of our business. Now, of course, all good news, especially for those in the UK, panned out when HSBC came in, and we didn't have to take anyone up on their very kind offers for support. But what it was a phenomenal signal of who had capital and who had an intent to deploy it and who would be good for a conversation kind of a little further down the line. Now, the reason why I'm telling you that story is because I don't think it's any different when it comes to the concept of merger or buying businesses in the space. I think from a founder's perspective, it's a really healthy measure in a conversation with existing investors of their understanding and support for the space that you're in, and also their appetite to keep deploying capital. And I think it's frankly part of the job that comes with being a CEO or a founder is to be opportunistic. And these things they come and go so quickly. I've already had, where are we? We're on month 3 of this year. And I can count just off recent memory, 4 or 5 different options that have landed in my inbox without me pursuing them for the space that we're in terms of young businesses that haven't been able to raise additional capital and now looking for a safe place to land a business. So A, I think becoming more prevalent, and B, even if you don't go ahead to make these acquisitions or make these mergers, it's a really good way of finding out who's got deeper pockets and also who's following your journey closely and believing in the mission. Does that make sense?
It does. So so you're saying you've had quite a few startups get in touch with you and say basically, hey, would you like to buy us? How do you evaluate those opportunities, and how much information do you extract from those companies, maybe without leading them on, being unfair if that really isn't your intention?
No. And actually, the answer from my side is really simple. We're a young business, very, very focused on our own operations, our own growth, which has been aggressive the past 18 months. And so, frankly, we don't have bandwidth as a relatively early kind of founding team. We don't have bandwidth to go on this kind of exploratory hoover in 20 different businesses, data rooms, and compare them, all that stuff. In fact, we're very reliant on our fund investors to give us market pulse, because they're perfectly geared up to do that. And so I'm sure you'll direct that same question somewhere else in a minute. But it's also important to have a view on what would be valuable for your business and why, so that when that opportunity crosses your desk, it's not opportunistic. You have to go away and think about it. It's almost like a muscle memory. You think, yeah, I've been waiting for something like that. I know exactly what to do with it, and I'll take this as an opportunity. So it's kind of stand for something or you'll fall for everything. And so we don't tend to get drawn into the speculative, we have a business that is for sale, we'd like to share it with you, are you interested? And we are much more following a short list of companies that we've been impressed by, but think maybe capital constrained and struggle to raise if they haven't hit their numbers. And if those names appear, then of course they trigger immediate action from the team. But the plain English answer is, Amy, difficult is a polite way to phrase it, even when a good opportunity arises.
Okay, and Rebecca, so how do you work with startups, or what's your kind of advice for companies in terms of being aware of both companies that you might want to buy if they were to come up for sale, as it were, but also companies you might want to sell to, and make sure you're on their radar? Like at what point in a startup's journey should founders be thinking about both of those aspects, and how do you actually go about, drawing up that shortlist?
Yeah, massively important topic, because I think it's one of the unspoken rules of taking venture capital, is that at some point those venture capitalists would like a return on their money, and therefore as a CEO taking on VC money, it's your job to be continually thinking about that. That doesn't mean you're continually actively seeking an exit, but you should be continually thinking of it, aware of the market around you, both competitors but also opportunities. But I think it goes back to first principles for us, and that when you're thinking about an exit for a business, the best businesses are bought and not sold. And what I mean by that is, I have I think it's very, very rare, especially in the VC world, that a business with 3 to 6 months of cash can find a good home for their business or a good upside return for any of their investors. And so really, as you're kind of navigating the growth of the business, always having one eye on who are the people that may eventually want to buy this business, having the relationships with those people. And then I think even more fundamentally important is understanding why they might want to buy your business, because something I've learned, through the years, some of the exits that we've had at Octopus is often not the obvious reason why they're buying a business. You think they're buying it for distribution, actually they're buying it for the tech stack. You think they're buying it for, the revenues, they're actually buying it for the brand. So really understanding that nuance, because I think that then helps you, not that you should run your business with a view to what your potential buyer might want, of course, but having an understanding of what matters to which buyers, so you can navigate conversations and positioning with those buyers in the right way is super important. But I think it's a sort of long-term relationship. So we had, if I give you one specific example, it was out in the public domain. We had an investment in a business called Tails.com, which was a subscription pet food business. And the CEO there had a relationship with the buyer at Nestle for the best part of 3 years before they came forward with an offer. And they only came forward with an offer because we were about to raise a big Series B round of funding with the business, and they jostled their way in to make an acquisition offer at the last minute. Now that simply would not have happened if not only were Nestle aware of the business, but they had the relationship, they understood the trajectory of the business, and they knew the strategic value for them of buying that business at the premium that they paid at that point in time. So it's really, really important to do. And I think you can do it in a really simplistic way. Like most of the businesses that I work with, particularly as you become a bit later stage, is you'd have a standing agenda in the board deck, which is, okay, what does our landscape look like? Who are our competitors? Who could buy us? Where would we add strategic value? And continually thinking about that at board level. So I think that's when I think about the opportunity for founders and what the kind of responsibility is, I think thinking about exits is that there's a similar vein if you're thinking about IPO as well. I mean, Mike can talk to this a bit more as well, but the journey to an IPO is many years. You don't just wake up one day and decide that you're going to go public next year. There's many things that you need to put in place, the right structures, the right governance, the right reporting. You've got to warm up the market. There's it's so many nuances to it that you need to have a really good view of that. You really need to have a good view of whether it's the right thing for your business and for the team. So it's basically a long process on all fronts, and being prepared and having the knowledge is the most powerful thing. To your second question on the opportunity for startups to kind of grow that way, I think you're right in that there is increasingly, but I don't think it's actually more than normal, but you do increasingly see, like Alistair was saying, some of the opportunities that land in his inbox. We get them all the time that, hey, this business is not quite managed to raise, it could be a good fit for X. I think that's part of this ecosystem. 60% of businesses fail outright, so you'd sort of expect that to happen. But I think people and founders should think about it more positively, opportunistically than that. This is not necessarily about picking up the odd business that's not really made it, but actually, could 2 + 2 = 5? And where are those opportunities? And can we, we've had some businesses in our portfolio that have done this very successfully. So I think about businesses like Secret Escapes, who've expanded into other markets by acquiring businesses based there. Another portfolio company of ours, Outfittery, based out of Germany, who kind of slowly marched, Julia has sort of slowly marched around Europe, acquiring all of her competitors, and not necessarily at a massive discount to their market value either, but just recognizing the synergies of bringing the businesses together and the power of the combined. So I think that's more applicable for businesses at a later stage, to be honest, when you think about growth opportunities. But it's something we're definitely seeing increasingly happen. And again, I think it's a missed opportunity if you're not considering those things, having those conversations as a founder.
Amazing, thank you. Niccolo, before your exit, kind of, was that in the works for a long time? How did that come about, and what were some kind of key learnings from that, do you think, that other founders can take away?
I think it's very consistent with what Rebecca was saying. I mean, first, we've been in touch with ESL, and I've been talking about potentially, eventually it became a merger, but potentially a co-investment or some sort of partnership with ESL and Ralph, ESL's founder, since I think 2014. So we're talking about 8 years developing a relationship. And if I look at all of the potential exits we had, we have been in touch with all of them since forever. Since before hitting 1 million users, we were basically talking with every one of them. And all of the exit opportunities we developed over the years were relationships that we developed over years. And ESL was no exception to that. It was probably one of the first ones, and funnily enough, ended up being the one that we ended up merging with. So I think it's very consistent. It's something that as a founder, you need to keep in the back of your mind that as you're developing relationships with partners, you also need to think, who are the potential investors? Who are potential companies we might end up working with, also as a merger or a potential exit? And that's key. And I think I see it a little bit as both a founder on one side, that exited in that way, but on the other side, we also ended up expanding with an M&A plan post-exit. So I see a little bit both angles. And I think the other thing that is key is to remember that as you're trying to sell a company, I think Rebecca said it, it's not easy to sell a company that has 3 to 4 months in cash. And you're not simply going to find someone that is going to save the day and come and buy you. Ultimately, building a competitive tension on one side, understanding why certain buyers might be interested is key. And in doing so, I think having a clear expectation and a real expectation of what is going to happen is important. I think what we've seen over the last 2 years was expectations finally getting back to reality in a certain sense, and founders understanding that their options are limited, and that 2020 and 2021 were an exception rather than the rule, which is what I think is helping now to find a way to get some mergers done. And that expectation is key, because in a merger, especially if you're talking about 2 startups or 2 companies coming together, there is a lot of people. Ultimately, business is made of people. And Mike, I think you've seen our merger process. You need to put a lot of interests and a lot of egos into a room and make sure it works out. So on one side, you can be lucky. I think we got very lucky in having a lot of people that managed to get along together. I'm happy to have a great co-CEO that, despite my ego being huge, we managed to get along. But reality is, you need to make sure that the price is very clear and very big. So as Rebecca was saying, 1 + 1 equals not even 2 or 3. It's we're talking about 10, 100. You can do things together that there is no way you're going to be able to do if you're not together. And at that point, if it opens that sort of doors, for us, it was going public, or eventually, as ended up happening, selling to Savvy and starting a roll-up of the industry. Those are things that on a standalone basis, no company would have been able to do. And if it opens that door, then it works. If it's simply a way to, again, do 1 + 1 equals even 3, I don't think that's enough to actually get it done.
Yeah. So you hinted at there's going to be multiple different people with different kind of interests around a table when you're trying to get a deal over the line. There'll be investors who are investing on different timelines, or are able to hold for longer, or perhaps want an exit, or want a certain valuation, or don't. And then you've got several founders. Mike, how have you seen negotiations go most smoothly? What are some things founders should be aware of going into that, and how can they perhaps line things up to make the process as smooth as possible to get a deal done?
There's probably never been a better time to ask that question, Amy. I think that what I mean by that is that, you know, in the run up to 2021, everything was going up and to the right. Every investor who'd come onto the cap table was seeing a nice potential multiple on their investment, and you know, they were seeing the hold period, the amount of time for which they were invested in a particular company, you know, 3 to 5 years. That's all changed. So we've now got a lot more tension in the cap table, where you have early stage investors who have been holding for a very long period of time. The secondary market has all but fallen away. So there's no particular ability for them to exit, and the pressure has mounted on those cap tables. So I think the smart answer to the question is that the founders should be speaking to their investors, and not just the latest round investor. I'm talking about right through the cap table, to make sure everyone is as aligned as they can be in this market, make sure what their intentions are. If there is a secondary opportunity, particularly with a new primary fundraise, maybe there's a little bit of secondary, making sure that some early stage investors who really need that liquidity can have the opportunity to exit, even at a discount. And I think that it's really just, I call it managing the cap table. I think it's a really critical process at the moment. There's no, there's no right way of doing it, but there's lots of wrong ways of doing it. And I think just making sure that everybody is as aligned as they can be, understanding what their hopes and aspirations are, and informing them of everything we've just been talking about. You know, who is out in the market, what the opportunities are, why you think now is the right or the wrong time to go to market, etc.
And thanks. And Alistair, when you were doing your deal, what were the kind of, what was in your mind when you were negotiating on points? You know, should founders be thinking, you know, only about price, or is it about how long you as a founder need to stay at the company after a deal is done? Do you need to consider employees? Like, what are all the different points that need to be negotiated, and how would you advise people to maybe not have too long a list of demands?
So great question, and invariably I'm going to forget some important parts and probably get shouted at on the chat, which is totally fine. But I'm fortunate where I've been through the exit process on multiple occasions and worked very closely with Mike Turner and his teams across some, in fact, across all of them. And I think a few things. The best thing that you can do throughout the process is remain like calmly communicative with your cap table. So that's not over-promising and under-delivering. It's not getting excited for any one potential investor or exit or any of this stuff. And in fact, I mean, if anything, arguably an indicator would be the more excited I got about a potential acquirer, the less appropriate they were when we actually got to the table. And so I kind of assume this now for a guy that is quite excitable in character. I assume quite a cool, calm, collected approach to this stuff, not because I want to, but because really the devil's in the detail. And it comes to stuff like this. Rebecca said, like, all the best businesses don't get sold, they get bought. And so really understanding the true motivation from the other side is important. Firstly, because you can be helpful and supportive of them if you understand what their strategy is, but also it helps you set your stall out in terms of value and importance and what points to drive. The number one thing that you should be doing as a CEO founder, in my very strong opinion, when it comes to exit, is optimizing for shareholder return. Like, the business wouldn't have started without their involvement in the first place, and you have to make sure that the shareholders get well looked after, period. Very close second comes to your team of people that put you there. Actually, my job, and in fact, my job is so much easier now starting businesses because I have lots of phenomenal ex-colleagues who have had good outcomes, whether it be for career trajectory or whether it be directly financially. And it's much easier now to bring them in on new opportunities, or get them as good reference points to introduce new team members to whatever you're building. And so I think in terms of founder reputation, that's so important. And then when you talk about kind of how long to stay with the business, I actually think it should be viewed as a bit of an honor for the acquiring business to invite you to join their excellent company. Bear in mind, this company is so successful that it's been able to afford to buy your business, and there are probably a thing or two that you can learn from the inside. So I tend not to think about like the idea of being tied up or any of this stuff. Go in with a bit of a growth mindset that you're going to learn something new while also seeing your baby that you've been building and growing and being really careful with over the years go on to bigger and better things. And so I think like wholly positive. I come all the way back to that first point. The more that you can communicate about the idea of there being interest around your business and just managing expectations, right? Not every acquirer has to be Google or Meta. It can be very credible trade sales. And in fact, some of the best offers we've ever had have been through businesses that I may have heard of by name, kind of, but I certainly wouldn't know the inner workings on. And it's really important to kind of hear those out and then be able to relay it back to the shareholder base. I hope that goes some way to answer the question.
Great. I'm going to take a question from Jack on the gnarly question of prices. Where are kind of buyer-seller expectations at the moment? Are we getting closer to them being the same? Jack says that from a large fintech corporate development background, we still feel/see that they are far apart and that is hindering deals. But as startups run out of cash, that will force their hands on the valuation side. Mike, does that ring true?
Yeah, well, look, I think it's a gradual process. We're certainly not there yet. We weren't there in 2021. You know, the seller expectations were incredibly high in 2021, and the buyer expectation is just that the coin has flipped, right? So I think it's always going to be a negotiation. There's always going to be a seller wanting to sell for more than a buyer wants to pay. That's the nature of M&A. So let's just start with that principle. But once you get beyond that, I think at the moment, buyers are nervous still about being seen to overpay for assets. You will have seen a lot more M&A that's being announced without the financial terms being announced at the moment, and we're finding out quite a bit that if there's no need to announce the financial terms, but they don't want it out there, and as buyers being nervous that they don't want to be called out for having paid too much, sellers maybe not having such a great story to tell about the exit price either. But look, I do think we're narrowing. I do think there are more active buyers at the table, more realistic sellers at the table, and that realism is beginning to converge. But I think it's healthy for there to be a gap, and there will always be a gap in expectations. The market will dictate whose favor that gap is in.
Who are some overlooked categories of buyers? I mean, Alistair, you just mentioned not everyone can sell to Meta or Google. Who are some really good potential buyers that founders should not sniff at?
Yes, you become more and more informed depending on the space that you operate in. And in fact, that it's been a fascinating journey coming on to 2 years now with Bloom, where we've entered what has been quite I call it a heritage market, which is a polite way to say not much disruption, not much innovation in the world of career coaching, professional development, mentorship. And actually, there are plus 100-year-old businesses that have built multi-billion-dollar giants all around workplace learning. They it was a pen and paper business where it would have started out, and they are very, very keen to get on front foot into more cutting edge technology. It's those that want to, for example, those that want to dabble in AI, for example, but don't want to go, don't have enough of a war chest or enough of an understanding to be funding deep tech deals, and so see this space as quite interesting. So I've particularly enjoyed engaging with the corporate venture teams in companies that are legacy but have large war chests, huge customer bases, but just like a dated offering. And I would say like look for those as like parameters or vectors to go and base your pitch off. Even if you're just raising investment, doesn't have to be for exit. In fact, it probably an argument to say better to take minority investment to begin with, get to know each other, and see how things materialize from there. But yeah, it'd be looking for those that have maximum pain. And people with businesses that have been around for a long time and not moved are, for me, a place I go looking first.
Rebecca, any add?
Yeah, no, I totally agree. So, I mean, if you actually look at the statistics on this, the big tech names don't buy a lot of businesses, right? A small handful, maybe. Some of them haven't for a long while. So it's often not those. It's often the legacy businesses that are much more active in buying these. Firstly, because they have the cash. So I think about like a Nestle or a Mars, like, I mean, public company data, but they have billions sitting on their balance sheet, right? And their organic growth is tempered by markets, and therefore they're looking for ways to grow inorganically. You know, they are actually the most active type of acquirers in these sorts of markets, because it's fundamental to them to underpin their share price and their valuation to keep showing growth and development. So often, and I mean, most people have heard of Nestle clearly, but actually it's often the businesses, like Alistair said, that you just no one's ever heard of. And they are, you know, been working away, building huge market caps in legacy industries, but have the capability to buy and build these businesses up.
Like two more, they're kind of similar questions from the audience, saying please keep them coming. From Patricia and Chigozi, kind of asking like, what do you do if there is a big gap between what someone wants to sell for and what someone wants to pay? Like, what actually happens in those negotiations? How do you value the business? Are there any mechanisms, or is it just a conversation? Mike, you must be privy to a lot of these.
Yeah, I'm smiling only because I think I'm seeing that on an M&A I'm working on right now, where I think, you know, there is that dilemma, there is that gap, and it's beginning to come quite wearing on the process. So look, part of the answer is this. I think it is. I personally find it very, very helpful in those situations where there's an investment bank or a corporate finance advisor sitting in the middle, typically sell side, but sometimes buy side as well. Those characters can then sit down and hash out the numbers. They can talk numbers, they can talk valuation models, they can talk expansion plans, they can talk everything. That takes the pressure off the founders, it takes the pressure off the buyers, it takes the pressure off the sellers. And I think that is a really healthy thing to have happen, because as Al has said, it is vitally important that a selling founder can feel very comfortable going into the buyer organization. And, you know, a backdrop of fist fighting over the dollars in the run up to the transaction is not healthy. It really isn't. And I know that both Nick and Al had help doing that in their transactions, and it made a huge difference, I think.
Yeah. Maybe one thing to add as you were speaking, there's an importance, and I'm talking to the founder community now when I say this, not the acquirers. It's like there's an importance for using the data that is publicly available to temper your excitement with some realism. Like a lot of these acquirers are public companies, and therefore you know what multiples they're trading on, and you can take what you'd be contributing to their business and extrapolate that out to understand, like in fact at a maximum, and if they're not putting a premium on it, you want to be able to offer them actually some gain in the multiple. If someone's trading at 10, then I always think of it like I'd like to sell my business at 7 or 8, and then even on just a pure arbitrage on my numbers, they're winning. Even if they got there and they said the tech wasn't strategically valuable, or they didn't like something we were doing with the team, or whatever it is, doesn't matter. You're saying, look, at a minimum exercise, my business is worth X to you because we know how you're positioned financially. And then of course you build all the strategy on top. I think if you do that as a founder, you end up with a much more realistic view of what something's worth. And then, Mike, let's be honest as well. Your business is really only worth what someone's prepared to pay for it. And that's great if you're running a competitive process, because you can nudge that up. But if you're not, and there's only one game in town coming to you, you guys need to have a really real conversation in the boardroom. And I must say that you've been world-class at that in terms of our experience over the years, just guiding people. Not to say they should take a deal, by the way, but saying that the deal on the table is the one that people are prepared to pay, and that's what people need to go and think about. It's just that area of realism.
Yeah, maybe just.
Oh, Nick.
Sorry.
Yeah, Nick.
Just double down on that. I think two things. The first one is the whole multiple discussion depends from why someone is interested in buying your business. And we had people coming up, oh, this is the multiple that you transacted at. I don't care about my multiple. I'm not buying your business for your revenue, and your revenue is completely different from ours. So, and the trajectory is different, and the management team and the moment, like it's it's something you can use in a transaction, as Alistair was saying, where you're starting to build competitive tension because you're running a process, and you actually the one asset that is unique in that industry or similar situations. But otherwise, I think looking at it, you really need to understand why someone is interested in buying your business, and that's extremely important because it's going to tell you where you go. I think making sure that the exit path is not the only option you have is key. Ultimately, competition and competitive tension is what determines how well you do. I think Rebecca said it. Good businesses are not sold; they're bought. And the moment that you're for sale, you actually start having an issue when it comes to price. And then the other thing that we've seen quite a bit is it's not always just oops. I guess I'm.
You need to pay the bill, Nick.
The light went off. Apologies. But basically, it's not just about the valuation. I think you have plenty of terms that might not seem as important, but that are actually important. And I think warranties is a very good example. Having insurance on them and who ends up paying that insurance is another example. You have plenty of terms that you can push one way or another, and the deal can be very seller friendly, which might not add on the valuation, but might actually make a difference in the long term.
Rebecca, were you going to add something?
No, it was the same point that Niccolo was making. I think it's all to do with if you understand who your buyer is and why they're buying you, you're more likely to drive a strategic premium. I think is sort of the summary of it. And then also having options.
This might be a bit of a stupid question, but we've spoken a lot about kind of getting to know your acquirer, building up relationships, understanding what their needs are and what they want. How do you actually do that? Like who is it the CEO of that company? Is it the head of, if they're enormous, their M&A team? Like who are the people to actually build relationships with, and how do you do that? Do you send them like quarterly updates? Do you take them for coffee? Do you like what's a good way of going about that?
Yeah, a bit of a mix of it all. I mean, a lot of these acquirers, if they're public companies, as Alistair was saying, there's a lot of information in the public domain. So you can kind of get an inside track on what do they care about at the top in that company? What are their strategic agendas, objectives for the years ahead? And how do you maybe slot into that? Who you have a relationship with depends on the company. A lot of the bigger corporates have corporate venture arms, or they have M&A teams that specifically just spend their time on that. But outside of that, really you want a C-level sponsor for the deal as well. That's what's really going to drive it through. The M&A team will be the ones that transact, but ultimately it's someone in the C-level that sees the strategic value of buying the business that's going to get a deal done. So yeah, so making contact with them directly, many ways you can obviously do that: direct reach out, ask for connections with common people. But I think, just building it over time, and also, some founders I've seen do this really well, is a realization often that person changes over the course of a 5 to 10 year journey. You need to make sure your kind of contact is up to date. But I think the human to human relationship is really important. So yes, send them updates, but spending time with them, getting to know them, getting to know the business is vital.
And maybe to add to that, it's not just about who do you want to connect with, it's understanding how the buyer thinks. Ultimately, it's like closing any deal. If you're selling something, and in this case, it's your company, you want to understand what the decision-making process looks like. And not every company is the same. I think one thing that I've seen many failing at is really understanding how the decision process works. And it's not just important in understanding who you're selling it, but it's also important in understanding at which stage of that process you are. I think I've seen, and this counts both for ventures and for exits, but I've seen situations where you thought that the deal was done with a term sheet, and there are some counterparties where a deal is done with not even a term sheet, a handshake. I tend to be one of those. If I give my word is more important than any contract. But then there are situations where until you have a long form, or even worse, until you have a money in the bank, the deal is not actually done. And I think understanding how the counterparty works what the decision process looks like, and what different people can input in that decision process is extremely important. Mike, I see you smiling.
No, look, I think you're, but look, I think you're both absolutely right. I think it's and I can't remember who touched on this first, but it's a people's business. No two companies are the same. Finding the right person, someone in the C-suite, as Rebecca says, and making sure you've got that direct engagement is really important. This is a people's world after all. You know, there's a check to be written, but it's all about can the buyers two and the sellers two add up to a lot more than four.
Question from Benny: what happens to deals that don't go ahead? Is there any like way of making use of them, or do you just politely say, you know, no thank you, or sorry, it didn't work out? Alistair's laughing.
An opinion, and actually just some learned experience, which is several of my best professional outcomes have come from some of my most painful professional learnings. And what I mean by that, Amy, is I've had a number of deals in my life not happen, despite, by the way, Niccolo's got the right accent when he says, like, I shake your hand and the deal is done. I would totally believe him, and I definitely wouldn't mess with him either. I'm like, that's good enough for me. But actually, unfortunately, nowadays, it's not the case, and it's really not until the long form's done and then some. And so we've been let down at the last minute on a number of occasions through no fault of our own, and frankly, sometimes no fault of the other party. But the reason why I'm sharing all that is, instead of being sad about it, we do two things. We've understood the buyer pain in intricate detail, like what was motivating them to do the deal. And then we've looked to map that pain against other places in the industry where we could, and it leads you to a new potential buyer. So it's like literally like a line of Skittles. You follow it and you'll end up at somebody else's door. And in fact, it came, the last exit we had, we were out trying to raise our Series B, and we were getting told why people wouldn't give us the money. And it led us to the fact that, they said, hey, listen, we actually think that you've saturated the market. We don't think that there are many more customers for you to win, which is a massive underhand compliment, but also a huge problem when you're trying to raise additional funds. And on an effort to try to prove them wrong, we asked ourselves who was an aggregator of loads of our potential customers, these thousands and thousands of retailers and merchants. And we ended up at Klarna's door, and the rest was history. And so actually, I would say, don't be too deflated. If you're a founder, you're used to no's and bad outcomes and letdowns anyway. I would say package it up and use it as a blueprint to try and find out who else fits that profile.
I'd add to that, Amy, as well. I think that, Mike mentioned it earlier. I think you really do have to have quite a lot of discipline in these types of processes, because I think, one, that's about aligning your cap table before you go into any negotiations. If you set a price, you've got to keep everyone honest, stick to it. You've got to time bound the conversations as well, because they're a huge distraction for the business, and you want to make sure that either something's going to come of it or you can move on. And as Alistair said, you could turn that into a commercial partnership perhaps, or there's another way of working with that potential buyer. But you as the company selling have to try and stay with your advisors, try and stay in control of the process and not be drawn too far, off the terms or in terms of the length of the process, like really sticking to your original plan on it. Because otherwise, most processes fail actually, statistically, rather than succeed. And so you have to have that in mind. As Alistair said, big pinch of reality. It's not done until it's done and the money's in the bank. So it's probably going to fail. So let's make sure the business is still working. I've still got enough cash. All the shareholders are still supportive, and we still have a plan B firmly in play if this doesn't happen. I think that's like fundamentals that is easy to say, hard to do in the emotion of a process. I can't imagine how the founders of Figma are feeling right now, having kind of spent their 20 billion and now having to walk back from that. That's a really, it's a difficult place for any founder to be, I think. But having people like Mike around you, having advisors that can kind of keep you on track, keep you honest to the process, and help you to move on from that process if it doesn't work out, I think is critically important as well.
Nick, to talk a bit about what happens once a deal is done, what's worked well for you in terms of kind of bringing teams together? What are some things that founders need to have in mind and be realistic about when a company is acquired or two businesses merge?
Yeah. I think, again, looking at both points of view, I've seen this as an acquirer and I've seen it as a founder exiting. So I've seen a little bit both. I think as an acquirer, what I learned is making sure you have the right incentives in place is extremely important. So making sure that a founder is still engaged and has still skin in the game. I think you go through a process as a founder where you go from being in your house to being a bit of a guest in your house, and making sure that that process is not hitting a wall day one, but rather something that takes some time and engages with the founder in a positive way, keeping them engaged into the business and keeping that drive is extremely important. I think on the other side, understanding why someone is selling is extremely important as well, and making sure that, and ultimately is linked to that, you want to understand whether a founder is going to be engaged, what you need to do in order to keep them engaged, and whether you want that founder to keep being engaged. I think in our case, putting two, or in a certain sense, three companies together was extremely challenging, but what we understood is we were all driven by something in common, which was really building something unique. We all believed that 1 + 1 equaled way more than 10, and we started executing towards that. I think cultural clash is another one that is something to keep in touch. Again, a business is made of people, understanding what they want and the culture that each of the businesses has, and how much of that you want to retain is extremely important. In reality, I think also being very honest with everyone that it's the beginning of a change process, and it's a change process that you'd rather acknowledge and manage rather than just going in and rushing for a couple of years to realize that you're actually destroying value by not acknowledging it, and that people that used to thrive in a certain culture might not fit in the new one anymore. And at that point, it's better to acknowledge it, manage it over a couple of years, than again just hitting a wall.
It's a great point, Nick. And if I may, I'm just going to say that, you know, for it really, what you said highlights the different way that a founder needs to think about a sale and institutional investor does. For an institutional investor, it's a proper exit. For a founder, it's actually the next stage of the journey. Often it really is. You know, for a founder, for an aspirational founder, a great sale to a great buyer can lead to, you know, huge growth in the business and really an opportunity to fulfill some ambitions that perhaps staying single, as it were, would not allow. So it's a very different thought process.
Alistair, what were some learnings for you from going through that, both in terms of the impact it had on the team, you know, working for a much bigger organization, or just for you sort of no longer being the big boss?
Interesting. So let's focus on the team, because there are these two conflicting points of view, but two conflicting emotions that will come from your people. There'll be a school of thought that goes, this is amazing, I've been wanting to be part of a bigger company anyway, so it can have more grown-up processes and larger payroll for my career aspirations, and they're wonderful, and it's true, and that can and should happen. And in fact, there's often a talent mapping exercise that happens pre-acquisition, and I would encourage founders to spend more rather than less time doing that, because it's kind of like the real final gift that they're giving to their people, to make sure that they are well connected at the right levels for their career stage into the acquiring company. I think that's a really big one that people don't talk about very much. So that's one school of thought that's very positive. And they say, brilliant, we can't wait to be part of a bigger company. We've been waiting for this. Fantastic. They also happen to be most often the colleagues that are prominent on the employee share option pool, and stand to make something from the deal as well. So I think just as like an ethos, if you can be a founder that believes in sharing across the company, which I certainly am, I believe everybody should benefit. Of course, if you put in your own money and you're a founder, you should benefit at a different level, but that everybody should benefit for their effort and input, then it certainly helps those outcomes at exit. And then there's the other school of thought, which is, I didn't want to be part of a big company. I joined particularly to be part of the startup journey. That's the end of this. Or I specifically don't like the acquiring business. By the way, can you imagine the polarizing views of selling to a buy now, pay later provider? Some people loved it. Some people hated the concept. But actually, here's the one reassuring thing to everybody, is you don't know if you don't go. So why would you not go and at least try it? No one buys a business with the worst intentions. No one's buying this to kill it. They're buying this to try and bring it to an even bigger, better life, and that you're going to play an important part of that. So the earlier you can connect your people in with the acquirers teams, them understand, the look, feel of the offices and who they're going to be sat alongside and all that stuff, the better. And I think it's a really important part of the exit process that, by the way, is not the shareholder's problem. It is yours. As the CEO is literally, as it says, it's like your ultimate responsibility is for the successful operation of the business. That includes handing over the keys at exit, if that's the way it's structured. So I feel quite passionate about that, making sure the team land in a good place and everybody understanding why. On a personal note, I've certainly gone through some conflicting emotions about it over time. It's changed my personal outcomes on a financial level more than I ever would have hoped or dreamed as a young guy going into business. I am a quintessential founder CEO, so I come into every meeting being like, why are you doing it that way? I would do it better. I have a different way. You should listen to my way. It's awesome. And obviously that doesn't play well when you're inside a business that has a very competent CEO and leadership team and they already have their ways of doing things. So I think it's like going back to that point I was making earlier, going back to that growth mindset, even for you if you're a CEO or founder, trying to learn something as well as contribute something. And of course, the satisfaction that will come from making sure your team land well, all roll into having high potential for a positive outcome. Do you mind me phrasing it like that, Amy? Did that answer the question?
That's perfect. A question from Joe Lewin, another rare Lewin out there in the world. Joe says, how important is profitability to buyers? Like, how important is it that your company has got to profitability, as all VCs have been asking companies to do for 18 months or so now? Mike or Rebecca?
Well, it's going to be all important to a financial buyer, quite clearly. To a strategic buyer, I think Rebecca made the point earlier on, look, strategic buyers buy businesses for lots and lots of different reasons, and it may not be important. It really may not be important. There may be something, as Rebecca said, in the tech stack, or the people, or the customer base, or the geos that they operate in, which are going to dictate why this business is particularly attractive to a particular buyer. So look, I don't think it's critical, but let's all be realistic as well, that it was you were a rock star if you never made any profit in your startup up until 2021. Now all of a sudden it's getting a little bit more important. So clearly there's much more focus on financial discipline now, and Rebecca, I'm sure you're finding that in your portfolio as well.
Yeah, I mean, I think it comes, the profitability point, I totally agree with Mike. Not for all strategic buyers, it's not necessarily important. Frankly, they're all going to look at your cost base and see where there's synergies and what they could strip out anyway during an acquisition. So I don't think it's the be all and end all, but it comes back to options. So if you think an IPO is a potential exit route, profitability, certainly for the next few years, is definitely going to matter to public market investors. If it's a financial buyer, it will definitely matter. And frankly, if you're running your business profitably anyway, you have the biggest power anyway to walk away from a transaction. And in any negotiation, that as the backstop, that plan B is super, super important, and profitability ultimately gives you that. So, I think we always advise our founders, you shouldn't build your business for what an acquirer might want, because you don't know who that acquirer is going to be. So build it with good fundamentals, and they will place a value on it that they see fit for whatever their rationale is at that point in time. But it's never going to be a negative, put it that way.
And I think today, especially as you start seeing a lot of startups that are not able to raise again, or not at least at the same terms and are starting to combine, that profitability is actually extremely important in getting it across the line for two reasons. Acquirers are way more careful about burn rate following the deal. And the second thing is, as Rebecca was saying, gives you time, it gives you optionality. And at that point, it's the optionality you need in order to get the deal done often. I've seen it a couple of times lately.
Amazing. Okay, we have 4 minutes left. So one final question from me is, I guess, either one word of advice for founders out there who are thinking about how they get an exit one day, or one mistake that you made that other people shouldn't do.
What a good question, Amy. You can tell everybody's thinking about it. So my mistakes are far too numerous to list and difficult to pick from. So instead, I give some encouragement, which is to all the founders out there thinking about this. Like, in my experience, I've never regretted the deal that I got done. And in fact, the only ones I ever look back and think, oh, could I handle that differently and better, are the ones that I didn't get to complete. So my big encouragement would be come in pragmatic, have as much information to hand as you possibly can, and manage the people around you, whether they're investors or colleagues or otherwise, accordingly. But literally, you've worked your backside off to get to this point where someone's quasi interested in potentially acquiring you. For goodness sake, find a way to make it happen. Be realistic.
I'd take echo something Rebecca said. Don't build your business. I've heard so many founders talk about building their businesses with a view to particular buyers being interested in buying it. Do not do that. It tends not to work. It really doesn't. Build the business that you think is a scalable, valuable business. The buyers will come to the table if you succeed. And so I think it is just, and I saw another question saying, is it ever too early to sell? Of course, it's never too early to sell it. It's all a thought process around the market dynamics at the time, your personal aspirations as a founder, the check size that's being offered to you, and et cetera, et cetera. So it's something and as Al said, he was out raising his Series B when he sold Hero. So that would tell you something. So I think it's just be very, very flexible. There's no book on how to do this. Just think about building the business well, and then good things will come to you. Excuse my dog barking in the background, apologies.
Rebecca?
Yeah, I think it's probably the statement of the best businesses are bought and not sold. It's really, really simplifying the whole conversation that we've had, but being mindful about this, being thoughtful, being prepared will set you up really well. Building relationships with folks like Mike, other advisors in the industry, surround yourself with people that have knowledge of this, have been through it. Just understand it so that it doesn't blindside you, and you'll feel much more empowered to make the right decision and drive the conversation when that time comes, than trying to catch up on all fronts when that offer lands with you.
Nick, final word is yours.
I think it's very much what also Mike was saying. I think your best alternative is what you really need to work on. And ultimately, your best alternative, the best you can build, is building the best business. So as long as you focus on building the best business, even while you're running an M&A process, that's the real alternative you're building. And that's what's going to make sure that good things actually happen also under an M&A perspective.
Amazing. Thank you so much for everyone. I have learned a lot during this.